This is a download from BFM 89.9, the business station.
Hi, good morning, George. So the U.S. market closed not very well over the weekend on Friday, down 0.3%. This coming from Janet Yellen's statement that there may be interest rates rise. Now, isn't this a little confusing since the minutes reveal that the U.S. economy isn't exactly back on track?
Yes, Julian, good morning. It is rather unusual, but she is pointing something out that's very, very important. The open question is no longer if, and the question really is no longer the vague open-ended when. Yes, we had weak May U.S. economic data points. That obviously delays the start of the rise. But Chairman Yellen did say the Fed will likely start raising interest rates this year. And in terms of the timing of the first move, we have definitely transitioned in terms of the important drivers, beyond that of just being data dependent. She has recognized that the lags involved in setting our monetary policy will cause us to not be able to delay the tightening until employment and inflation are back at the objectives, given the risk of our economy overheating. So the issue is no longer when the Fed's objectives have been met. It is data dependent to start when our data are strong enough to avoid an economic relapse, not when we've met the objectives of inflation, for example. So it's very much a transition from the economy being innocent until proven guilty to the economy being guilty until proven innocent. The economy has to prove that all that the economy has to do now is to prove that it can support itself, and Yellen will start the interest rate rise.
So, Dodge, can you just take us through some of the things that confirm, some of the data that confirms that the U.S. is on the rebound? Because what we read from the headlines that inflation is still very sluggish, below 2%, and employment figures are not as hot as the Fed want them to be. So what are some of the other signs that the economy is actually recovering?
Well, Julian, what would really help, and it's kind of unusual, but we've talked about it before, and in terms of unemployment, we'd like to see the unemployment going up because that means that more people are coming back into the economy and trying to get jobs. They're not being counted now, so that is misstating the unemployment rate. So that's going to be a driver. The fact that inflation is beginning to raise its head is also very important. And the consumer, if you see, there's really a mixed story in terms of earnings. If you looked at retail, some companies, Macy's did not report well, but other companies did. So it's really not straight across the board in terms of improvement yet. What Yellen needs to see longer term is a more consistent improvement in terms of the more traditional ways of defining employment, and we're not seeing that yet. And although we're seeing a lot here in New York, we're seeing a lot of activity in construction. It is still too early to convert that to an overall improvement in the New York State economy, and so we're beginning to see more traditional signs, Julian, but the traditional signs are not overwhelming. And really, Julian, the real problem is going to be Yellen's going to have to move quicker than the traditional signs are going to support in order to avoid the other problem which we've had in the past. So she has to tread a very narrow path now, but it's clear that it's either going to be September or December at this point. And if it isn't, that's going to give a message to the market that's not as positive as if the transition were to occur.
Now, she also warns of further bond rout. Will this have any impact? What kind of impact will this have on, say, the U.S. dollar or some of the emerging market currencies?
Well, we're going to have to watch this because a stronger dollar means less export, which means less likelihood of our interest rates rising because it will create the impression of a weak economy. We do need to see a stronger dollar for the time being. It will have quite an impact if we do continue to see the stronger U.S. dollar on the euro dollar and also in Asia, particularly Japan. Japan's beginning to recover now. I suspect that they're on the road to economic recovery, which will continue, and that will be an innocent until proven guilty. I think they will continue to improve unless something occurs outside their economy that will affect their exports. But right now, the U.S. dollar being stronger, we are on the lead in terms of the transition to higher interest rates. as long as we stay ahead and we can lead the European interest rates higher into a stronger economy, I think things will be fine. But there will be some rocks in the road that we're going to have to transition, and that is more based on the perception of our increase in interest rates, not the actual increase in interest rates, because even if we start this year, Julian, we will, the rise will be very slow and it'll be over years.
Now, with regards to the bond route that Janet Yellen talked about, what kind of other fallouts, apart from obviously the bond investors, that you see?
Well, there may be a positive effect on U.S. stocks. I think there'll be a negative impact on the Eurodollar and the Euro markets on the loan side, on the increase in interest rates that they may have to at some point start themselves. In terms of the U.S., I think the transition is going to be much smoother, but in the short term, the fact that the start has not yet happened is going to lead to a rocky conversion until we get over to the other side. In terms of the Eurodollar, I suspect the Eurodollar will benefit from the strong U.S. dollar for another 6 to 9 months.
Now, you have in the past spoken of a two-gear equity influence, one from liquidity and the other one from a growing economy. Where are we now, Dodge?
Well, we have transitioned. For a period of time, there have been various factors that we've had to watch every single day. Geopolitical, earnings and economic, commodities, interest rates, and foreign exchange all had a bearing on what was happening to U.S. stocks. We're now beginning to see a transition away from the overall impact of any of these to where additional variables were moving the markets, but only in parts of the markets. For example, take for example oil. The price of oil now is really more impacting M&A activity and therefore the value of oil-related companies and not the U.S. economy as a whole. One of the negatives that we're seeing in another part of the U.S. economy are airlines. Airline stocks are hurting because of the increased competition that's resulting from lower oil prices and the need for airlines to try to increase their utilization. But again, it's just airlines. We're not talking about the U.S. market as a whole. One of the other areas that's being affected by the price of oil are the Dow Jones transports, and there is a Dow theory that says that transport should be moving in line with the economy. But again, we're not talking about an overall effect of the price of oil on the U.S. market. So we're beginning to see a transition from all these different elements affecting the whole market to affecting specific elements, and that is part of the natural transition as we get more to economic and fundamental valuations and away from this low interest rate environment.
Thank you. That was Dodge Dolan, Chairman and Chief Investment Officer of Lander and Fust Capital Managers in New York.
Thank you for listening to this podcast. To find more great interviews, go to bfm.my or find us on iTunes. BFM 89.9, the business station.